Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update podcast. This is Craig Jeffery, your host today on this edition. We are talking about scenario and sensitivity analysis. I'm joined with my colleague, Paul Galloway. Paul, welcome to the Treasury Update podcast.
Thanks, Craig.
Yeah, I want to ask you a number of questions in and around scenario and sensitivity analysis. Maybe we can begin this discussion of scenario and sensitivity analysis is why this may be more of a concern than normal, given changing interest rates, volatility among FX currency pairs. We won't even talk about commodity price swings and inflation. Maybe as part of your answer to the question is, what is scenario and sensitivity analysis? Maybe you could roll some of that in as we move forward in our discussion.
Yeah, sure, Craig. Definitely scenario sensitivity analysis has become much more important in today's environment. We currently have rising interest rates. We have inflation. We have geopolitical issues going on, not to mention COVID impacts, supply chain disruptions. And all these different things that are happening have an impact on outcomes of either projects that we're working on or decision points for raising capital or mergers and acquisitions or leasing or investing in products, all kinds of different things. When we think about scenario and sensitivity analysis, I'll go first with, what is scenario analysis? Scenario analysis is simply saying, I took a base case analysis I put together for any one or any number of projects or things that I'm looking to make decisions on. And I change one or more variables. I could add or subtract a variable that I have in the base case, but you're changing multiple variables at the same time or removing and adding variables. And what this does is for the various events that I talked about, allows you to take a look at impacts to, and generally it's normally financial impacts to what it is that you're running the analysis on. And so you're trying to figure out, does this change the outcome to a point that I would make a different decision than what my base case says? Sensitivity analysis is different in that it looks at a single variable and you pressure test the variable. You can do extremes. Maybe it's bandwidths of, hey, if interest rates increase by X percent or drop by X percent, what's the outcome of changing that variable up and down? And so that's the difference between scenario analysis and sensitivity analysis. Obviously in today's environment, there's so many things that are having impacts on decision making today that these two approaches to looking at variables tied to an analysis are more and more important.
Maybe to see if I've captured the way you described that correctly, the sensitivity analysis, you're really, let's say you have a number of variables. Sensitivity analysis is you're isolating one of those. I think you use the term pressure test. You're jumping inflation or interest rates up or down, a certain amount to pressure test or stress the curve. The outcome of that will show you what that does to your portfolio, what that does to income or cash flow or some other outcome. Is that an accurate reflection of that, or would you add to that?
When it comes to, pressure testing those variables, I think the way you stated it is correct. It's fair. That's exactly what you're wanting to do with sensitivity analysis.
So what are some of the variables that treasurers are focused on with regard to either scenarios or sensitivity? We already talked about FX, interest rates, inflation. Are there other key variables that people are usually testing?
Obviously, interest rates and FX are two things that treasurers are focused on. They're focused on these things for a variety of reasons. But when you think about interest income or interest payments, or when it comes to paying for something in a foreign currency versus your US dollar or local currency, as we term it here, you, as a treasurer, you're going to be monitoring these various things. And treasurers often have to make decisions around capital management or capital funding. Some of the components tied to that are interest rates in general, what's going on out in the markets. And so as the Fed raises interest rates or rates are rising in markets, the underlying benchmark rate that's used to determine cost of financing will change. And so if it's fixed, typically it's treasuries that we're looking at. If it's floating, used to be that LIBOR was typically used, but now that LIBOR is going away, you're seeing issuances come out in using SOFR, which is a US-based floating rate benchmark that a lot of treasurers are using today when it comes to capital financing with floating rate instruments. So when you're engaging in capital management or raising of capital, you're going to monitor the markets and see what the impact is to debt or financing for your cash flows and your costs. The other thing you're going to be monitoring as a treasurer is what's going on with foreign exchange. So in particular, we're seeing right now that the dollar has been strengthening quite significantly against the euro today. The euro most recently reached parity with the US dollar, and that hasn't happened in a long time. So when you're having to pay for things in local currencies that are, non-US dollar local currencies, say euros, for instance, you're interested in what's going on with those rates. So you will run scenarios or sensitivity analysis to determine what the impacts might be to the financials, to your costs, to your capital raising, and also determine, what does that mean from a risk management standpoint? And so risk management comes into play. Do I want to engage in certain activities that will help me manage the risk of either rates, interest rates, or foreign currencies moving on me in a direction that might be adverse?
Okay. So I think that helps with the sensitivity side. And on the scenario side of things, I'm not sure you described it this way, but this is where there's a number of these, your base set of assumptions, your base case. This is moving a lot of them all at once, right? So it's interest rates could move, FX currency rates could move. Like you said, a base rate of something can move, like your borrowing cost is based on SOFR or whatever. A scenario manages these or looks at these all changing at once. And that's different from this pressure testing one unit at a time. Is that how you would describe that?
Yeah, Craig, scenario analysis is different in that respect. So you always start with your base case, but you're always kind of wondering, okay, if these particular events occur, which, we're looking at more than one variable with scenario analysis. We're saying, hey, if these particular variables change either up or down, or a particular variable doesn't happen at all, or a new variable is introduced, what does that mean from a decision-making standpoint? And as I noted earlier, we're typically talking about what's the financial impact. That's what a lot of these analyses are from a treasury perspective. What are the financial impacts of these various scenarios that potentially could occur? And, like I talked about earlier, in today's environment, there's so many different things that are going on. Not only sensitivity analysis is more important, but the scenario analysis is more important because what you're trying to do is be able to make good decisions around the particular analysis that you're working on. So scenario analysis is an important tool in addition to sensitivity analysis.
Yeah, very nice. I want to push on a couple of those things a little bit more to get a little deeper on those. So this, the idea of protecting the organization, protection is a good term. and this is a bit of a setup question. Is it protecting your organization as the avoidance of risk? Is it the reduction of risk? Is it the alignment of risk appetite that the firm has? Is it something else?
Yeah, that's a great question, Craig. And what I would say is it can be all those things. And sometimes it can be multiples of those at the same time. When it comes to risk management and running scenario analysis, sensitivity analysis, it'll allow you to determine, okay, where does the risk lie? What variables really matter? Does it change my decisioning with potential changes out there? And so you're trying to get bandwidths of potential outcomes. What's moving interest rates? I move them up, I move them down. What's that bandwidth look like? I run scenarios of introducing new variables, taking out variables, and changing variables, key variables all at the same time. What does that mean? And so you're trying to get a better understanding in terms of what potentially could happen and where the risk really lies, what variables really matter. And without doing these analyses, you can't. And so you can get, with doing them, you can get alignment of risk, meaning you align to what the risk appetite of the company is. You have elimination. You can eliminate risks. Either it can be contractual or it can be part of the structuring of the particular deal that you're working on that the analysis is for, or it can be risk mitigation in the sense that you're trying to reduce risk but not completely eliminate it. So there can be things that you do again and contractually and in the structure that help mitigate some of those risks or lower them. So it's elimination, it's reduction, it's alignment.
Yeah, excellent answer, Paul. So, as we look at these scenarios, you mentioned adding new variables or removing other variables. I'll ask you for an option there, and I'll mention one client. We did some risk management analysis with. One of the first functions or first activities was identifying their risk capacity and risk appetite, and then identifying those elements that fell within that range that variability could create a situation that pushed them out of the comfort range so that would drive them to take some action to reduce the risk to keep it within their risk appetite. And since there was a number of things calibrated, there's certain items that fall in that range and certain items that aren't there yet or are very small. And so as part of the process was monitoring those items that were growing and changing and identifying when they might become a bigger risk. So if you're doing more business in a foreign currency, at some point, that could be a new variable. That would be one example. It might be commodities, or it might be doing business in a foreign country. Are there other ones that you would want to add in, or other ones that you would take away? What would be examples of either of those as something else?
Yeah, Craig, when it comes to variables that will be monitored as a treasurer, obviously interest rates, inflation, and foreign currency are items that would consistently be monitored. The other things that I would think about from a capital management standpoint, the underlying benchmark, i.e. interest rates, treasury, SOFR, or otherwise. When you're doing capital funding, there's always a spread component, which is tied to the organization's rating. Your Moody's, S&P, AM Best, depending on what kind of organization you are and who's doing ratings on you. Ratings, can have an impact on what your spread is. What also can have an impact is financial performance and how the market perceives the organization. So monitoring the organization's spreads compared to what's going on in the market is really important. So you're working to get data from bankers and other sources to be able to understand what the impacts are to capital funding or financing particular items for an organization. So you definitely want to monitor those in addition to FX and interest rates, inflation. The other thing for consideration would be items that would have a direct impact on a company's line of business or line of businesses. Yeah, so whether, you're a manufacturer, somebody that builds products, or somebody that has a service. That's how you distribute whatever it is that the business is known for and does. You'll want to monitor things that would impact the organization that way as well, because that would have an impact on cash flow or projected cash flow outside of items that are known already on the books. So from a forecast standpoint, you're going to want to understand what are those key items that should be monitored on a regular basis and be part of your sensitivity analysis, scenario analysis that you would do either for reporting purposes, forecasting purposes, or decision making when it comes to a particular project. Craig, one of the other things for consideration would be, on the risk management that we talked about just a little bit ago. As a treasurer, often you're engaged in hedging. So you might buy options or sell options depending on what you're doing from a hedging standpoint to offset a perceived risk or to mitigate a perceived risk that's out there. And so treasurers often will engage in hedging for interest rates and foreign currency because it could have a direct impact on the business. So as I mentioned earlier, we talked about capital management or financing. You may do interest rate locks, or we could have an example of, hey, we're going to pay for something in foreign currency. We talked about euros and euros reaching parity. Well, movement with a stronger dollar relative to the euro, we may want to hedge movement for whatever reason. It could be we're paying foreign currency or we're going to receive foreign currency. It could go either way. You may engage in an option to hedge any perceived risk in the movement of that currency at the time you go to strike a deal versus the point at which you actually pay cash to close the deal or receive cash for close of a deal. So options are a tool that treasurers will use to manage risk.
Yeah, excellent. I'm going to just mention a couple of those terms for those who may be newer to risk management or may not be in finance, and just add to what I'm saying or correct me if I say something that's not accurate. So optionality, for example, is let's say you're going to purchase something in a foreign currency in a month or two, or let's say it's a date certain 2 months from now. You might do a forward contract that fixes the price US to Swiss francs, for example, or euros, and so you set that. There's no optionality to it; it's just a future dated item. But let's say you're looking to close on a deal, but you don't want to suffer currency moving against you, and you're looking to buy a company that's going to cost you $50 million. You want an option on that, for example, so that if it happens, I can pay and fix the rate. But if it doesn't happen, I don't have to buy the euros because I didn't buy the company. And so that's a level of optionality which is more complex because it's more expensive and it's volatile. That's certainly a definition of optionality. Is that how you're using it in this environment?
Yeah, Craig, I alluded to earlier the idea of paying for something in foreign currency or receiving something in foreign currency and trying to manage that risk. So as a treasurer, you have the ability to go out and engage in, could be a forward contract. It could be an option to buy or sell something. In this case, we're talking currency. So if you're going to, let's say you're going to pay for something in euros, for instance, you're going to pay X million dollars of euros for something and you want to hedge that risk. You're not going to pay for it today, but you're going to pay for it down the road. You engage in buying an option to purchase euros at a certain price, sometime in the future. It could be that it's date specific, that happens on a certain date, or it could be, hey, between now and a particular date, I have the right or the option to purchase euros based on what we agreed to in the contract. If euros are moving a certain direction that would be adverse to me, if I exercise the option, I'd be better off, meaning I pay less US dollars to receive the same amount of euros, then I'm better off having bought that option. Now, there is a cost associated with an option, but as long as the cost of the option and the cost of paying for the euros is less than what the current market environment is, I'm better off. One of the things you can do as a treasurer when it comes to managing some of these risks using options is you may run simulations on interest rates or foreign currency to understand what the impacts are, potential impacts are, a range of impacts. You can have a model, you can have a set of key variables, you can set parameters around those variables and run a simulation to see what outcomes might be. And what I mean by simulation is I used to use, this was some number of years ago, a software package called Crystal Ball that allowed you to run Monte Carlo simulations where I could see what the impacts of changing variables given certain parameters I put around those variables in a given confidence interval and desired distribution outcome. I could see what those impacts are and run 1,000, 10,000 different scenarios or simulations of changing those variables based on the parameters I put into the system that's tied to a spreadsheet and see what the outcomes are. And these simulations can help you understand risks and where you think things might end up landing.
I wanted to mention one other term when you talked about simulations and sensitivity, stress testing a particular variable, or you run a simulation. So the simulation is, you said it could be multiple variables. So maybe it's interest rates, maybe and inflation, or maybe and FX. And there's a range of expectations for interest rates that maybe you plug into the model. It could go between these two ranges, and same thing with FX rates or whatever the variables are. And then this simulation is, it's running those variations according to the model, and all those numbers are being cycled in and out to give you multiple items tested at once. That's what you're referring to as a simulation, right? This automated running of multiple variables that are all changing within the designated ranges that you control in this scenario. You're running a simulation based upon the scenario and the model that you've put forth.
Yeah, that's right, Craig. The simulations allow you to pressure test key variables that are tied to a particular analysis. And you can run 1,000, 10,000 simulations all at once. Well, not all at once. They're happening, it seems to be all at once. It happens over, a very short period of time.
Seconds oftentimes, yeah.
With a lot of these softwares that are add-ins into Excel, you can actually see everything changing, the distribution being built as the simulations are being run. And you can see also the count on how many simulations that have run at the particular time that you're in. And so you could stop it if you wanted to. You could pause the simulation and just take a look at what the outcomes are. And then you could start it back up again until it's run the 1,000, 10,000, however many you told it to run. And you can do that with setting up a certain range to each particular variable that's of interest. So it could be interest rates, it could be spreads, it could be foreign currency rates, it could be inflation assumptions, it could be discount rates. It could be all kinds of different things that you could set parameters up around. And then you can tie a certain level of confidence, or let's call it a confidence interval, that's tied to the distribution outcomes, because you'll get in the simulation, you'll get some outliers, something that will be like really negative and something that will be really positive that could distort where the most likely scenario is to land. And so you kind of want to throw those out with a confidence interval. And so that allows you to do that in the simulations. And you could have them skewed to the left or to the right, meaning that something could be more positive or more negative based on the parameters that you put in the model for running the simulations on key variables.
Yeah, that's excellent. You said something I thought was really, really important in terms of, you said range. That's such an important concept in risk management. It's, we oftentimes get to this, well, what's it going to be with interest rates are changing, food prices, other commodities are moving, adjusting. What's going to happen with the, currency strengthening, weakening, our changing business mix? There's so many variables and people want to know what's the number. And you basically said, we run these scenarios to determine a range. And you've used the term distribution. So what do you mean by range as opposed to what's the number? Paul, I want a number. Don't give me a range. That's hedging, right? But what does that say about how we manage risk or how a risk manager has to think?
Yeah, by running the simulations given the current parameters that we put around key variables and running a confidence interval, what the range does is it tells us what the potential low outcome or negative outcome could be and what the potential upside or positive number could be. So you can have top end, bottom end. And so that's the range, and the range, depending on what the outcome curve looks like, will inform you, given a certain confidence interval, most likely where the outcome will land. And that helps you with decision making along the way. The range is really pretty important to understand, because a single number by itself, it tells you something, but it doesn't necessarily give you enough information to understand what really matters from a decision-making standpoint. So getting a range, understanding based on scenarios and sensitivities, running these simulation analyses, they help you from a decision-making standpoint.
Yeah, excellent. Either prevent it or limit the range that it moves. These are great concepts. The next question I have for you is, there's different models. I think you talked about probability-based distributions. What are the three common ways of basing these scenarios, simulations on? How would you describe that?
There's more than three, but there's three that I found to be most common through my experience. The first model is a quantitative-based model, and we kind of talked about all three of these already, but didn't really call them out. But the first would be quantitative. This would be a model that's focused and based on particular key quantitative variables that can impact decision making or an outcome that impacts decision making. The other would be probability based. And so for key variables, we set up a certain probability that an outcome would happen, meaning that interest rates are X percent likely to be this. And, the next set for interest rates is X percent for the next, whatever that interest rate is, so on and so forth. So you're putting probabilities around outcomes for key variables tied to an analysis. The other one would be event driven. And this has become more prevalent today, and why scenario analysis and sensitivity analysis is important, because there's lots of events that have happened in the past couple of years. COVID, Russia invading Ukraine, other things that have happened to disrupt supply distribution. We've had a lot of different things that have happened. And most recently in the U.S., it's inflation. And so now interest rates are rising. So we have certain events that are happening that we need to run analysis to understand what those impacts are. So the three again are quantitative, probabilistic or probabilities, and then the other one is event driven.
Yeah, Paul, as we draw to a close, I wanted to just ask you about accuracy. As we run these models, there's assumptions, there's ranges, there's a number of not only variables, but elements that go into it. So maybe asking, does accuracy matter isn't the right question, but how much accuracy matters, or what would you say about accuracy of this?
That's a great question. I always tell anybody that is an analyst or runs the model that once you have an analysis completed, the only thing you really know is that it's probably wrong. So the question is how wrong are you and what direction are you facing? What I like to do is with my analyses, when I run an analysis, is I want to make sure I get myself, to use a golf analogy, I want to make sure I'm in the fairway. So when I have an analysis with a set of outcomes, whatever analysis I've done, scenario analysis, sensitivity analysis, simulations, I want to be in the fairway, preferably in the middle of the fairway, meaning I've got the ball landed in the sweet spot of what the potential outcomes can be. The other thing I want to be directionally correct. So I always think in terms of, am I in the fairway and am I directionally correct? Meaning I'm helping the decision maker make a decision that gets them to a favorable outcome.
Yeah, I think the fairway model sounds great, right? You're hitting it, you're out of the rough, you're into the fairway. But when you say directionally correct, that seems like, some of these models could be positive or negative cash flow or whatever you're testing for could vary one side or the other. And so, when I think of the fairway, it's like, what if you hit it in the opposite direction? That can be the case with the distribution. I really like your fairway model the best, right? That captures this spread, this bell-shaped curve or whatever the shape of the curve is. Like, I want to make sure I've got it right in the center.
Yeah, fairway, absolutely. Directionally correct is also important. And, I can give you an analogy that's a real life example of where I've run analyses that showed that if we engage in a particular activity, it was most likely going to be a negative outcome. And so that's an example of being directionally correct the opposite way. And so sometimes we think about, well, directionally correct means that you're heading towards the most advantageous thing. Well, it could be just the opposite, that, hey, if we go this particular direction, that will be disadvantageous. Well, we don't want to go that way. So it helps you make a decision not to do something. So directionally correct is also important.
Perfect. I really like that explanation. Yeah. Dead center fairway, maybe you got it spot on. The left or right of the curve, you're still in the fairway until you're in the rough, until you're in the woods, until you hit your golfing partner who was sitting off to the side. Paul, this has been good fun. Thanks for your time and comments on scenario and sensitivity analysis. Really appreciate it.
Thanks, Craig. Been a great discussion as usual, and look forward to the next one.
Take care.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.